Good afternoon. Ira Epstein of Linn Associates with your agriculture update, and this is for Tuesday, the 30th of April, 2019, about 2:40 p.m. Central Daylight Time. So we're finishing off the month on a pretty sour note in the soybean market. The wheat's getting hit. Corn didn't get much of a bounce. It was amazing yesterday, again, that the corn's really not that far behind in anything. Wheat is, if you take a look at where the wheat growth is taking place, it's a little bit behind normal. Still the market down. And soybeans, the big question is a trade deal. How do you get rid of supplies that you have that are burdensome? Even China doesn't need as much meal, oil, anything right now. They have their own problems and still culling their herd. So that becomes interesting. For those of you that keep up with the herd issue in China, the African swine fever, I believe it was today, if I'm correct, Argentina had, I think, 25 processing plants approved by China for pork export. So that's going to help their business a little bit there. As you can see in the market, you're down now to 841, so you're down roughly from 925 to 841. What is it, 84 cents or so? That's quite a bit of a drop in the market overall, almost $1 a bushel. And you can see how this market has just leaked away. This is called a market looking to find a value area. You drop until you find it, and all of a sudden the market will get a sharp reaction as the market hits that point, as the shorts start saying, we've overdone it. With the stretch out today on a Tuesday after a lower Monday, in fact, it's still not at that point apparently. When you look at the swing lines, you got a clear picture of lower highs, lower lows, and one heck of a thrust to the downside. Now you've got the 18-day average of closes. That's the 18-day moving average of closes at 893 and a quarter underneath the last swing line. So even a big jump in the market of 25 cents or so, actually 40 cents almost, still would not take out that number, and you'd hit that 18-day average, and that number's going to drop again tonight when we lose one of these numbers back here that make up one of those 18 days. When you come at the Bollinger Bands, this is called riding the Bollinger Band. We had described this just yesterday. The first attack of a Bollinger Band often, not always, often results in a bounce, and you got your bounce. Then the question is, what does the market do? If you're coming out of somewhat sideways action, the question is, does it grab traction in terms of momentum and just drive the market? Now, only 5% of the time do you close outside of a Bollinger Band. You did that here a couple of days, actually about several days in a row. Then you bounce to the right, and you've been staying to the right, which is within the band, riding it on the downside with an embedded slow stochastic. Embedded means the slow stochastic average typically trades between 80 and 20. Traditionalists will call anything over 80 overbought, anything under 20 oversold. I go beyond that. I view different numbers, the 70-30 ratio, and I teach that in my charting course, and I teach as to why. And embedded means that the market locks in with both numbers that make up that indicator. They're called a K and a D line, going sideways or lower under 20 for several days or more. That's a sign the market is now converted from being oversold to locking in a thrust to the downside, and until that's lost, I would expect rallies to be met by sellers. In the meal market, it's very similar. It's not as pronounced as it was in the soybean market, but you can see how you're riding that band. Now the question is, do you have 3 days in a row under or more? This day, that's both numbers under 20. Yesterday, both under 20, and both under 20 on Friday, not the day before. So you've got your 3-day requisite. If you lose the reading by the red line closing over 20, it often leads to price and the 18-day average making a run at each other. Does it have to hit each other? I've learned in charting nothing has to do anything, but you play the percentage odds. That's what you're using a chart for. And yeah, that would be it. But until it's lost, what's it telling you? It's telling you that good rallies in the market are still probably going to be met by selling. In the soy oil, you've got the downtrend. You do not have the embedded reading. You're just oversold. You had a breakdown right here. 2 days ago, Monday, you jumped over the Bollinger Band again. And even though you're down sharply today, you're staying to the right-hand side of it. It's an orderly break in the market. In the corn market, we still have the pattern of lower highs, lower low. The question, of course, is if now you take out this 366 level, it's right into the 18-day average, but it would break the down pattern. So the market's still bearish in a correction mode where it had gotten oversold, and now the market, as you can see, the numbers are both numbers that make up the slow stochastic with the close today back over 30. You're no longer in the oversold area. So the question is, on this bit of an attempt at a rally, does it get going anywhere, or does the market revert, take out today's low, and attempt another run at wherever the Bollinger Band shows up? In the wheat market, still very bearish with an embedded reading, lower highs, lower lows. Here too, you had gotten under that Bollinger Band, moved to the right-hand side in your correction. Now you're challenging again. Certainly nothing bullish, but you've hit downside targets again, so you got to be a bit cautious. In the sugar market, I'm going to show you yesterday's action. Now, you are oversold, so that's important. I think we had said if you get a good rally yesterday, the potential was that wherever that 18-day average and 100 are, that could be the resistance if you get a heck of a rally. You had closed under the Bollinger Band. You got your rally today. You hit 1275. That is the 18-day average of closes, right back down 40 points from there. So oversold, yes, but still the resistance showing up where it should. In coffee, for those of you that get my morning subscriber video, I was pointing out as the market rallied this morning, and I've been saying this, each time so far that we've hit this 18-day average within short order, day or so, the market gets thrown back. It did it today. It got over that number. It tried to put the trend with higher lows, higher highs, and at first getting a settlement over the 18-day average didn't occur. You kept the pattern of higher lows, higher highs, but you could not close over that 18-day average. Now, if you take out 91.80, this sideways action that's tried to go up breaks that pattern. You'd end up with a higher high and lower low. So if the bulls want to grab any control at all, they can't afford, in my opinion at least, to take out 91.80, and they have to get prices back over that 18-day average. Right now, I'm going to call the trend neutral. Swing line up at bias down. In the cocoa, I was expecting a battleground at the 18-day average of closes. Yesterday, you settled over it. The key was, do you take out 24.13 or do you fight your battle against that number? The market told you today. It did not get up over 24.13, and it came back down, settled under the 18-day average. So the bears, as I see it, still control the market with lower highs, lower lows. It's been in a corrective mode at this point. What do I mean by that? You had gotten oversold, and now the momentum is at least no longer pointing up the way it was yesterday. You see that? Today it's somewhat bending. We'll find out what it can do tomorrow, obviously, but I think at this point, until you take out 24.13, the bears are trying their best to keep control. In the cotton market, back down today to the combination of the 100-day average in green and the Bollinger Band. Oversold market that's hit downside targets, but that's all I can say about it. You would think that, cotton might get a boost with Secretary of Treasury Mnuchin, Mr. Lighthizer there, our trade representative. No bounce there, no bounce in soybeans. In the meat market, what a washout in this cattle market. You do realize you were just in the 125 area. You've lost $10 of that straight down. That's just a market that somebody took over. The same in the feeder cattle. You've gone from highs for the year, you're just falling apart, and at least you've stalled in the hogs, but that's all you can say. You're oversold in a downtrend that is stalled out against the Bollinger Band, but the trend is down until this market gets back over 91.42.5. The bears have control of the market even though it's oversold. One of the things during the day that I look at on entry points in market is one of my favorite tools called a pivot point. Now, what a pivot point is, and I learned this from a lot of traders years ago, is it's a formula that uses the previous day's range, and we teach you the formula. You don't have to do it by hand, but it's always great to understand how it comes about. And what you're looking for is this white line. It's called the pivot out of that. And from there, you're going to get sell signals, resistance, they call it traditionally, resistance level 1 and 2. Some people, you can take this formula, go as many different resistance levels as you want. A lot of FX people go out 3 or 4 different levels, but most futures markets go out no more than 2. And the idea here is that as the market's moving along, you're trying, if you could, to get short at the resistance level, covering at the pivot level, or buying at the support level, kicking out at the pivot, or you can do it on the bottom. Hit this support, kick out at that one. We teach the different theories of it. Then what I also do is in this 3-part video series, I tie together momentum from the slow stochastic with all the tools with that. So now you get an idea about in and out trading. And pivots are really for in and out trading. They're not really a position trading tool. They're for the person that wants that in and out trade during the day, looking to see is the market at an extreme where you might get a bounce on it. If you go beyond the point, what's the norm if you get beyond it, where the market could just keep going on you? We talk about all that. How you get this 3-part video, call my staff, or you can go to our website. It is free. On the website, sign up for it. We'll send you an email with the link you need, and away you go. I'm Ira Epstein. You have a good day. I'll see you all tomorrow.